Well, good morning, everybody, and welcome to this early Saturday morning edition of the Expected Returns Review. And this is really something we started doing a couple months ago as I rekindle the monthly newsletter. I've been crunching pretty hard on the monthly newsletter here the last day or so, having a lot of fun, just kind of crunching through some topics that I know are of interest to the general audience. And again, this is just the type of session where you can come and perhaps get answers to questions or toss other questions out there, or even more importantly, give me some ideas of things that you'd like to kick around. Or I have a extensive laundry list of companies to add to the database this weekend, thanks to our friends in mid-Michigan and Ken Kabul and a couple others, and we will do that. We are getting into almost driven by necessity. The innovation type stuff that's going on with electric vehicles is going to push us into some of those companies. And I just have this gnawing curiosity about, what about finding a company that wins no matter who wins in the electrical vehicle wars, in terms of some type of battery technology or chemicals, or just simply the electronic hardware that's involved. I think back to the Mutual Club of Detroit, the stories about not choosing a single television manufacturer back in the 1950s, 1960s, but instead going with Corning Glassware because they basically provided equipment to all of them and benefited from the advance of television into a modern society. And perhaps we can do something similar to that with electric vehicles, and that's kind of what we're going to be kicking around a bit. But as far as today, I'm going to cover a few things. The Solomon Select choice this month is Samuel Adams, Boston Beer, ticker symbol SAM. We will take a look in at the fund manifest, the best performers, and just a quick commentary on ETFs and mutual funds for those of you that may not have been with us on Tuesday when we talked about that. We'll give a quick 10 cup update and again an acknowledgement of the Groundhog Challenge at the half. It's quite a horse race this year. And I'll just kind of warm you up. One of the things that I am experiencing personally is just this reminder that, a year ago, Ken and I put on the program Chasm Cartography, where we basically reminded ourselves that when we get into these nasty moments like we had in March of 2020, that really the long-term perspective prevails. And I'll confess I'm sometimes guilty of drifting away from that or becoming skeptical or doubtful or just simply not paying attention properly. And if you really believe in the long-term perspective and you can find a company who will persist, that will persist through the challenging times, it can be quite the field of opportunity for investors over the long term. Maybe we'll see that with Samuel Adams. We'll talk about that. But the reason the COVID cancellation conference slide is on there is because in the screening results, we'll go over here in a minute, a number of companies keep propping up that had appeared during most recently our May conference, and then prior to that, the November conference. We've had 3 of these, and just an encouragement to go back and check a little bit deeper. For example, on Green Brick Partners, presented by Matt Spielman a few months ago, and he covered it very thoroughly, and I selected it for the roundtable fairly recently. It also appears on our screens a little bit. So with that, let's get underway, and not showing any questions at this point, so you guys apparently are happy on this Saturday morning, sipping coffee or your favorite beverage, and let's go ahead and get underway. Here's a reminder that no investment recommendation that is intended. This is an educational demonstration intended to illustrate and again underscore, bold, the demonstration of methods, philosophies, and techniques of the modern investment club movement, principally as we've interpreted them here at Manifest Investing, but they're very consistent and compatible with the views of the National Association of Investors, now known as Better Investing. Everything you hear will be my opinion. If somebody chimes in and raises their hand and has something to share, that will be their opinion too. Please judge that accordingly. I do try to remember to remind you when we actually hold a position in a company, in a portfolio, but please do your own homework, make your own decisions. If you would like an invitation or an email reminder to the Roundtable, our monthly webcast, which has just been chugging along magnificently for 11 years, beating the market by 4 to 5 percentage points, that actually comes out to an annualized rate of return of about 19% for the companies that we have actually brought to the floor or brought to the table at the Roundtable. So if you'd like a reminder on that, please send an email to ncavula1@comcast.net. We get hundreds of people attending that particular session every month, and you generally come away with 4 or 5 ideas for stocks to study and perhaps a study technique or a way of digging that you hadn't thought of yet, or a brand new place to turn to for information. If you'd like copies of the slides from this morning, or if you have follow-up questions, or if you have a topic that you'd like to see us cover in our Tuesday afternoon bull sessions, please let me know. Send an email to markr@manifestinvesting.com. All right, looks like everybody's happy. I don't see any questions on the comment screen here. Here's basically the layout of this month's newsletter. The cover story, which I'm actually crafting right now, has to do with this notion of chasms, economic chasms caused by disruptions, and the spasms they cause in the rhinos, and how if you're not careful, you can get basically sucked into the abyss with them. And then this notion of reconciliation with the projected return on value versus PE that we have talked about. So even in prepping for this morning, I ran into a few companies which were clearly disrupted, and often that disruption can come from the analyst covering the company getting a little bit zany, and again, we're just watching for the variances or the weird numbers, or this doesn't belong here, and then putting them through an audit or a reconciliation using the projected return on value to condition projected PE values, that sort of thing. I think can be very powerful. It's something that we'll be talking about in much greater detail. Probably have a full-blown workshop on that in the not too distant future. As I said, Boston Beer, ticker symbol SAM, will be the featured stock. That's been getting crushed here of late, and we'll talk about that. The featured fund, we covered this a tiny bit on Tuesday at the bull session, but Fidelity Blue Chip, just a reminder that a lot of fairly well-respected mutual funds actually have an exchange-traded fund counterpart that you can take advantage of and perhaps save a few pennies, which add up over the decades. We'll cover the stock screen, looking for excellent companies with leadership projected return on value. And Tin Cup, we just added a few more shares of our Australian/New Zealander A2 milk company, but Tin Cup has continued to do pretty well. We'll take a look at that. And then we'll close a little bit with the Groundhog Challenge at its halftime. August 2nd is 6 months into this year's contest, and it is quite a horse race. So let me know if you have any questions out there. It looks like we're fairly clear for right now, but let's go ahead and get underway. Here's some quick screening results, which I thought the audience might enjoy. We call it the Sweet 16. We basically look for a manageable number of companies to look at and study a little bit deeper. Keep in mind that a screen is a starting point. And in this case, the primary screen, I said, I just want to look at excellent companies. So the quality is greater than 80. And the secondary screen in this case is the highest projected return on value. So what you'll see here is this is sorted by this column here, the projected return on value from highest to lowest. And this is a parameter that we hope to put on the company report pages pretty soon and make available in the screening parameters at Manifest Investing in the stock search. So you'll be able to display this type of result here fairly soon, we hope. Kurt is in the middle of the software upgrade, so hopefully we'll bring that to fruition here fairly soon. We'd hope to be done by the end of July, but like many things in the world of software and just life in general, sometimes they take a little bit longer than we'd hoped. But in this case, you see Green Brick Partners. Again, the reference to Matt Spielman earlier, giving a solid presentation during that investing conference back in May. I would encourage you to go back and take a look at that if you want to dig in deeper on Green Brick. Quite a study. Micron Technology I presented at a roundtable a couple months ago. And there are a number of steel and material companies that are showing up on here, which could be worthy of some interest. There's some home builders, Pulte and D.R. Horton of note. I do think the long-term tailwinds are in place, along with Green Brick Partners. Should mention up at the top, that's a home builder. Malibu Boats is on the list here. And a number of companies. iRobot is a company that I brought to the Successful Investing Conference back in May. So from top to bottom, these are some pretty decent studies. Some of them triple play candidates, and again, they all share this characteristic of really nice returns versus the capital structure of the company, and they all are considered to be excellent based on our quality metric. So let's go ahead and keep pressing on. Here's a quick look at tin cup performance over the last month. We actually had a pretty good month, and this is the look actually going back to the early days of Manifest Investing. So 15 or 16 years of results. We published the stuff every month, and we did restore to back above 4 million. I think some of you may have noticed that I pointed out that we were above 4 million until the last day of June. So we have recovered, and we've been spending quite a bit of time closer to 4.1 million than 4 million here over the last several weeks. And the rate of return on this is now 15.8% since 1995. So it has been performing quite well. Again, the formula for tin cup is excellent companies at good prices, rinse and repeat. Here's a look at the portfolio sorted from top to bottom by their projected annual return forecast. Many of these companies have been in the portfolio for quite some time, but you can see that A2 Milk, which has been kind of oscillating between, say, $4 a share and $5 or even $5 and change, and it's oscillated back down to closer to the 4 range. So that has driven the return forecast up to the top because it's such a small position and we only had a couple $1,000s to invest. Just went ahead and accumulated a little bit more A2 Milk for the tin cup portfolio in the August edition. And from top to bottom, it all looks pretty good, even at the very bottom down here. And we spent some time going over this last month. EPAM Systems is probably one of the best examples you're ever going to find of up straight and parallel, just a considerably excellent company, very high growth rate, PE that goes along with that growth rate, but the lessons that we have taken away from years of doing this with the Modern Investment Club movement is even with a return forecast of 2.7, which is the lowest in this portfolio, that is still a couple of percentage points above money market rates. So we would basically suggest that EPAM be given room to run and kept in the portfolio. It is a pretty good size position, and it has performed handsomely. And we thank Cy Lynch for that one. Here's another look at the portfolio. Just want to kind of do a second opinion or audit, not using the dashboard so much, but what we refer to as a parade of opinions. And we'll spend just a moment going over this. If you have any questions about any of the specific entries here, please either enter a question or raise your hand, and I'd be happy to dig in a little bit deeper. But let's go ahead and take it from left to right. You do see our two most important characteristics, the projected annual return and the quality ranking for the companies on here. And one point I want to make, this may be confusing. The previous slide had EPAM systems at 2.7, and this is at 3.3. Well, that's after an update, and it's also reflecting a few days later down the road. So that's two different points in time. But again, down around 3% for return forecast. Keep in mind that the money market rate is, again, about 0.5%. So still a slight advantage to that. So from top to bottom, some pretty good looking numbers here. Fairly decent quality across the board from top to bottom. And what I have done is sorted this from lowest projected return on value to highest. And again, you would find companies that are potential selling candidates typically at the top of this type of a sort, and purchase candidates at the bottom. So you can take a look. The upside downside ratio, again, computed very much like a stock selection guide from the National Association. Only in this case, what we've done is standardized the low price in that upside downside ratio is always going to be the 52-week low. And the high price is the long-term projected price with the appreciation from the consensus-based study. So it basically keeps all of the calculations the same. You can never have a upside downside ratio go wacko because you go below the low price. You can't go below the 52-week low. Sometimes it takes a day or so for the database to catch up, but you can't do that. So from top to bottom, you can spot the companies that are more likely to be a purchase candidate, worthy of closer study. This Addis Home Care, which we added to the portfolio a few months ago, is trading down closer to its 52-week low. It's got decent characteristics for quality, seem to be doing fairly well in their carefully chosen markets to provide hospice and home care in a number of strategic geographies across the country, company out of Chicago. And there are some other companies down here. Jazz Pharmaceuticals took a bit of a hit, just concerns over their merger with GW Pharma. You can see that the upside downside ratio is checking in at 6.2, and Jazz has taken a bit of a hit, but I would argue that the long-term fundamentals seem to be fairly promising, probably worthy of further study, which leads us to it is the lowest relative strength index on the chart. That just simply is suggesting that perhaps the investing and trading communities out there in the world of investing are turning this into a potentially oversold condition for Jazz Pharmaceuticals. So the relative strength index, this is based on the 14-day look back. And so it's a traditional relative strength index that you would find at stock charts. This is also something that we expect to add to the screening criteria for the parameters available at the stock search at Manifest. So that could be some fun going forward. And then here are our opinions. The value line low total return forecast. Again, the weaker companies at the top, the stronger companies at the bottom with respect to buying versus selling. Again, value line is always going to struggle with the higher growth, younger companies, and you see some of that up at the top. So take that for what it's worth. We do look at the fair value and the price to fair value ratio for companies using Morningstar and the analyst consensus. And sometimes it just amazes me some of the differences you can see in companies. Like I like to point to, look at Amazon here. You've got Morningstar, which says they're maybe a little bit on sale, and the analyst consensus is just foaming at the mouth with enthusiasm for Amazon with that price to fair value ratio at 53%. You can see it's the lowest on the page, and so that the run up in the price and everything doesn't seem to be bothering them at all, and their assumptions are just for higher margins than we typically would end up with our studies. They could be right. I'm not saying that they're wrong. I'm just saying that it is what it is. They currently have a whole lot of enthusiasm and almost in a frenzy over Amazon as an investment. You see a little bit of that with Google also right now. I think Google's a pretty good study. In fact, the 10 Cup article, we talked about how good Google has been to the portfolio here in the last couple of months, and that life after Google is pretty good, and life with Google is pretty good too. The 1-year ACE again stands for Analyst Consensus Estimate. That's the total return forecast, and it just gives you a little bit of a feel for, a shorter term perspective. These numbers can be notoriously unreliable, but it does give you kind of a feel for, who might have a little bit more headwind versus tailwind. We love tailwind. And again, it just kind of lines up that the companies up at the top, the analysts do expect that they might not have a whole lot of upside here in the near future. And the ones at the bottom appear to be more attractively priced and closer to being on sale. And there's a caveat to this too. I think the analysts they just need to get their updates in and done, turn in their homework on First Financial, because I just think they're off on their homework. They haven't updated any of their target prices in quite some time. There's relatively few analysts covering that company. I just think that number is just flat out wrong. And First Financial has been quite good to 10 Cup and a number of places where Ken has chosen it for portfolios out there. See if there's any comments or questions at this point, or anything that you'd like to go into in any greater detail. Just again, a different look at 10 Cup, using some second and third opinions just to kind of double check our results to make sure that the kind of companies that would end up on the hot seat or would be deemed to be attractive at the hold or buy end of the portfolio, and it is fairly consistent. All right, let's go ahead and take a look at some other screening results just for kicks. I was trying to figure out, what company we would feature for Solomon Select here this month. I just want to issue this reminder that when you go into the screening mechanisms at Manifest, you can stop before doing the stock search and just simply go into research and what Kurt has given us. And this is a personal favorite, and one that many people have said that they just love to use as a launching point before doing any screening whatsoever, is this kind of auto screen that comes up. So when you actually drill down into research and look at companies, this is on the introduction page to doing that. And you can see some of the companies we have talked about. Addis is up at the top of this list. Google appears. Facebook is on here. Gentex has been in a number of conversations here recently. I've always been kind of infatuated with Steel Dynamics, although the growth rate's a little bit low compared to some of the others on here. Notice that the regional banks are showing up here. We're going to cover those in greater detail next Tuesday. In fact, this weekend I'm going to set off on a quest to explore if there are any companies that are not in our coverage with respect to regional banks that have leadership, robust return on assets, the parameter that shows up in stock studies at Manifest Investing and at Better Investing in the investment club world. Return on assets. So we'll be looking to see if we've skipped over any of those. Notice that Great Southern is on here. That's a 10 Cup holding, but interesting to see the regional banks showing up again. We mentioned some of the steel and materials companies being on here, and I have noticed a fair number of the integrated freight and logistics companies showing up on screens. So that's also just kind of a nudge, but some interesting companies on there to take a closer look at. Cy Lynch did present Mks Instruments, a repeat selection at last week's roundtable. So you can take a look at that and get a better pull there. Here's a quick stock search. Just again, I'm just literally holding a finger up in the air and trying to see which way the wind is blowing. I like to search for companies that have slightly higher growth rates. We're going to cover that here in a few minutes, but in this case, I just entered two criteria. I want PARs above 12, and I'd like growth rates above 12 just to see what I get. Again, I'm just kind of sniffing around looking for companies of interest. This is our first exposure to Boston Beer. You see Addis showing up again, Google showing up again. When companies keep showing up, iRobot, MKSI, Universal Display, interestingly enough, although the debate that we kicked around on the website says that that probably will get ratcheted down when we bring that PE down. Again, that's part of the reconciliation theme that we have talked about. Mercury System just took a fairly major hit. They had slightly less business and slightly weaker reporting, and took a pretty good hit. We're kind of in a market these days where if your company shares a little bit of bad news or a little too much honesty, they get massacred when it comes to the stock price. And then I think Mercury Systems probably fits that tab. Okay, just doing a quick check to see if there's any questions or hands in the air here. Just a couple comments. Some people agreeing with some of these companies showing up on their screening efforts here recently, and we are ending up in some of the same proven grounds. So here again is a demonstration of something we have talked about from time to time, checking for those oversold opportunities created by the rhinos misbehaving. When you go to the far right, you see the relative strength index. Again, we're looking for less than 30, and I tend to get much more interested when they're less than 20. Less than 20, and if you can get something between 10 and 20 that really lines up with things that you like to see, it can be time to go to work, digging a little bit deeper and deciding how much of an opportunity we could be looking at. So those are the ones that are overpriced. Now keep in mind, this is a minefield. This is a minefield. There are some companies, like I believe Arc Restaurants is, they might even be on a path to going out of business. I don't know. What I do know is they seem to be shuttering a bunch of stuff, and when you start looking at the fundamentals of the business, it's not looking really good, and it shows up in the sell zone, and again a lower quality. So what I generally am drawn to with a list like this is just what you would expect. These blue ones here, the higher quality companies. So without even looking at the names, I'm looking at the numbers and just kind of walking down this list, seeing these. Now I'll go over here and take a list. And here I do see Boston Beer. Samuel, I know a little bit about that company. I've done some personal research. I'm also swayed by the buys versus sells. The sells is, suggesting that there could be something weird going on, at least in the fundamentals in the company. Might need some updates, but I mean, there are some interesting companies. The Ardelyx story is pretty well told here at Manifest, and we're just hoping for the best. They just got an adverse ruling from the FDA, and kind of hoping that the next meeting that they can have with the FDA gives a clear path that's not too long to that solution that they're attempting to develop for dialysis patients. That controls first the potassium, actually it's first the phosphorus, and then they're also working on controlling potassium. A lot of medical experts are yearning for tools to help do that and make patients' experiences and lives better. And that company went from $9 to $2 in about 10 minutes a few weeks ago, and that smarts a little bit. And some people in the community did trim after buying between $2 and $3, and it got up to $8 or $9 there for a while. And I don't know, I'm kind of in the mode of hope. And everybody cross your fingers, say a prayer. Okay, getting a comment that Universal Display did take a hit yesterday, down 24.59. So yeah, it looks like Universal Display did take a bit of a hit. And again, I think that's an example of the type of company, probably why they showed up on this list, the type of company that, boy, if you misfire at all in this marketplace, especially with a higher PE, that's a little too high, in my opinion, but with a higher PE, you're going to get really punished, and probably fits that bill. Any other details that you can share on that one, Ruth? Raise your hand if you have commentary that you would like to add. But yeah, that's an example of a company that could present a buying opportunity. So from top to bottom, there are some interesting companies on here. A company like Vital Farms, I might, drag it across the coals to see if it might be the type of situation where there's a lot of room for improvement and likely improvement in the quality ranking over time. And it could be the type of situation where you can gin up some interest. Here's Jazz showing up on this one also. Okay. No more details other than the drop in price on Universal Display. And again, punished with such a high situation. So let's talk about Boston Beer. This is the one that kind of percolates off the screen for me. I'm fascinated that Boston is such the centerpiece of many of the themes here this morning, between Fidelity, which is going to show up here in a few minutes when we talk about mutual funds, and in this case, the fishermen operating off the coast of Massachusetts. And with Boston Beer, they basically had a situation a couple of weeks ago where they had their quarterly conference call, and the management basically said they didn't look very smart for not recognizing a major drop-off in growth with the truly hard seltzer. And I don't know, I'm kind of torn on this one. I see a lot of it consumed in neighborhood parties and at picnics and that sort of thing. It is popular. Is it a temporary rush of popularity? They do seem to be out there in front, doing fairly well, capturing more market share, but it's almost as if somebody turned off a spigot when it comes to May and June, and it really did put a dent into what was achieved versus what was expected at Boston Beer. And kind of an awkward conference call, and so I kind of characterize it as a little bit of a perfect storm, the George Clooney movie. And I'd written a long article about the NASDAQ about 20 years ago as another perfect storm. So it's kind of a nostalgic moment for me. But here's a look at the company and in the visual analysis. And what I want to draw your attention to is it's not completely up straight and parallel. There are some waves in this. And we can have a debate as to whether or not the product that they put out is discretionary or it's a consumer staple. I would argue probably somewhere in between. But they have had their moments with, kind of fluctuating or cyclical selling over the years. But the general long-term trend is that of a growth cyclical, one with a fairly healthy growth rate. And the growth rate that has been kicked around for years has been somewhere in the approximate 20% range. The truly hard seltzer has been bolstering that. The expectations here are probably reflected in these dots here on the right, that they expected sales to take off pretty well. They may not, they may restore, but even before this news came out, as we looked at the company, we were looking at a growth rate of 16 or 17%. That is the slope of the red line, 17.5%. So I can live with anywhere in the 16 to 17% range. And I can see that from left to right, most of those white dots, with a few exceptions a couple of years ago, are coming in pretty close to that long-term trend characteristic. So 16, 17% makes a lot of sense to me. And you can see that we're still talking about a $2 billion company becoming about a $5 billion company 5 years out. So it's a fairly healthy long-term situation. The one question that I went searching for an answer, and if anybody's got this one, please chime in. How much of their business comes from the hard seltzer? I actually looked in all of the normal places. I couldn't find a whole lot, and I dug into the 10K or the more recent 10Qs and didn't find a breakdown, but I may have missed it, may have overlooked it. If anybody has access to something, I would just like to know, when we're looking at that total perspective on sales, how much is the traditional beer beverages versus how much is this hard seltzer, and what what is the component, what is the comparison? And apparently it's growing faster with higher margins, so it is a component. You can see the bump up in margin expectations here in the net margin forecasts, and even Value Line was already projecting before the bad news hit a little bit of a relaxation or a return closer to the long-term trend of, call it 11, maybe 12% if you do a study of the company, but that number does seem to make a lot of sense unless the hard seltzer stuff completely falls apart. When it comes to PE ratio, yeah, some of the up and down cyclicality of the company does result in kind of a python or kind of a wavy form here, but when it comes to future PE, I can certainly buy into anything in the 25 to 30 range. So hence you see a 30 on here. So the major news here is, a stock price that has gone from over closer to 1,100. We'll see here in a second. Has actually been cut back to 660, and I wonder if that isn't just a little bit overblown. The par now standing somewhere in the lower teens, and very high quality company, and nothing major untoward here other than to point out that the upside downside ratio simply says that the stock price is trading near its 52-week low. Do see a little bit more liabilities, a little bit less cash, but the return on projected return on value is quite healthy at 7.9, call it 8%. They don't have any debt. The relative strength index, again, is the trigger, drawing our attention to the company down in that oversold territory. And with the drop in stock price, the projected low total return forecast is now basically attractive from our perspective. So again, my instinct on this is probably didn't communicate this very well. Certainly did not build any expectation in the covering analysts. When you if you listen to the earnings conference call transcript from a couple of weeks ago, it literally starts, the Q&A session actually starts off with, gosh, you guys, I don't even know where to start or how to ask this question because it almost appears like you guys don't know what you're doing. Pretty cold and brutal from covering rhinos at Boston Beer. And that did send people scurrying for the exits. The exits are jammed full of rhinos. But like I say here, we've seen this movie before. I do think that the consumption of beverages is comparable to the reliability of chocolate consumption over the long term. And they do have a good product. Not their first rodeo. They contrary to what has been suggested, they do seem to know what they're doing. And frankly, as we'll close here in a minute, these guys were at the forefront of multiple, call it flavors, over the last couple of decades in managing that consumer experience fairly well. I also like to point out that this is a great example of how stock prices follow earnings. Take a look at just the shape of the general stock price versus earnings down here. So ultimately, stock prices follow earnings. We know that. So if we can expect, this type of earnings characteristic out in the future, even if it's slightly more subdued than previously thought, there's quite a bit of opportunity here. Here's a look at the stock price over the last 20 years to show you that it is a precedented experience. They've had moments in time, including that fairly extended trough that they ran into a few years ago. With the recession that hit back in here, the reaction was pretty nasty as the economy went into the tank. What I find kind of fascinating is this time around, boy, you talk about sample sizes. You might have expected something similar to this a year ago, and they did have a bit of a drop. You can see a bit of a drop here on the far right, but man, did this thing ever take off coming out of the chasm. You talk about coming out of the chasm well, and So I would consider this to be a company that has been on a very long-term march, a company that can be understood, company that has managed situations well. And each one of these occurrences in the past has represented something of a buying opportunity. Time will tell, but I wouldn't be the least bit surprised to see that longer-term relative strength index. Keep in mind that this is monthly. That's why it's not at 20. It's monthly. So we're actually looking at a longer term perspective here. But and in the short term, they've actually hit quite a shocking moment. So here's some of the verbiage behind the stuff that I've been talking about here. Basically, they missed. They came in less, even less than value line, and things had to be trimmed. But I draw your attention to the revenue chart up at the top, and I certainly don't see anything that would align with the word plummet. I mean, maybe they came in slightly lower than expectations, but that is certainly not an end of the world image of plummeting by any stretch of the imagination. Yeah, they came in a little bit light compared to what was expected, but certainly nothing resembling Armageddon or a really tough situation. So you can see they're talking about they're even gaining market share. So while the hard seltzer stuff seems to be on the downslope when it comes to consumption, at least what is getting consumed, they're actually gaining ground. So how about that? Here's a question that I did have. Higher liabilities, less cash on hand. I just wanted to get a feel for, well, what's that look like over the long term? And you can see that their total liabilities, which is, think of it as short-term interest. They have no long-term debt, so you are looking basically at the credit card balance for this company, and you want to know, is it something that has fluctuated? You would expect it to basically line up with sales, and again, a fairly decent picture compared to revenues. You can see the little bit of the trough that was there a couple years ago. So the fact that the liabilities are climbing a little bit, not terribly unusual. How about the cash? Has the cash actually been depleted and restored historically? So going back over the last 10 years, what we find is this is a fairly natural thing. Paying certain bills, whatever in the natural course of operation, this company has fluctuated around, and the drop that is shown here is not terribly unusual. So again, that projected return on value of 8 gives us a little bit of a warm and fuzzy, certainly precedent. So again, here's your look. The projected return on value in low to mid double digits or mid teens. Very high quality, pretty interesting situation. I'm drawn to the fact that these two are fairly consistent. Again, a slightly higher than average projected return on value, slightly higher return forecast. Using 17%, you could use 16, using 11% for projected return, projected net margin, and a PE of 30-ish. It's fairly easy to get to a par in the low teens, and again, potentially oversold. So it continues to generate interest from my perspective. And here's just that reminder that not their first rodeo. They have been amongst the leaders in multiple flavors over time for quite some time. In fact, we had dinner last night with a grocery store owner / manager, just talking about what the American consumer is faced with when they go into a grocery store. And I'd never really stopped to think about it. He talked about it in terms of 35 flavors of yogurt with fruit on the bottom, and then you throw the Greek yogurt stuff on top of that, and now you're talking about a scramble for shelf space, and certainly can make for a situation. I know I've done it. My wife sends me to the store for a certain thing, and I'm standing there in front of about 100 different options trying to figure out which one is right. Well, these guys have done very well in this realm of putting out some specialty beverages in addition to their core Sam Adams beverage, and on a seasonal basis, and managed it. They've got stuff that comes out around the holidays. So again, they're no strangers to this, and I think it's an interesting opportunity to study a little bit deeper, and I certainly will be doing that the rest of this weekend and considering it going forward. Any thoughts or questions on Sam Adams or things that you think should be kicked around? And again, if anybody out there unearths it, please feel free to send me just how much of their business is coming from these hard seltzers, because I have a sneaky feeling that it's not a major component of the business, and a lot of times these type of opportunities manifest in that form. They're basically concerned about a 10% slice of the business, while the 90% slice is just fine, and it can be one of those type of situations also. Okay, let's go ahead and talk about one of the places we like to go looking for ideas of things to invest in, and it comes from the fund manifest. These are the top performers over predominantly the last 10 years. So these are the top 20 that have the highest relative return. Now, a few of the funds, including number one, do not quite have 10 years of operation, so it's actually performance since basically inception. You'll see that for the Motley Fool Fund, for ARK Innovation. So we're not comparing exact time frames, but the fact that we're using relative return over here means that we don't have to be looking at the same time frames. We're always comparing the performance of the fund versus the Wilshire 5000 over the time frame shown. Okay, so in this case, ARK Innovation, even though they've been kind of ice cold for the last 6 months or so, as we'll see here in the Groundhog in a minute, the long-term performance is very strong. Kathy Wood and ARK Investments centers on innovation. You've heard, many of you here in attendance have heard us talk about this, so I won't beat that horse again. Certainly not a dead horse. Innovation and stuff that's going on is a source of really neat places to look for investing. Investing themes and investing topics going forward from here. So these are the ones at the very top. I did want to take a moment just to talk about how, well, some people will say, well, you're just performance chasing. Well, no, we're not. We're actually putting together a list of people who know what they're doing, and then using either the projected annual return or the projected return on value. These two columns, we're basically screening down within those for, which ones of these are the best positioned right now. And you can pick some of those up off the top. And one of the ones that we want to talk about here is Fidelity Blue Chip Growth, which is, again, a relative newcomer. And it's mimicking an existing long-term traditional mutual fund. This is an ETF. If the ticker has an M in front of it, it's a traditional mutual fund. If it's there without an M, it is an exchange traded fund, an ETF. And you can see that we're now up to about half and half. A few years ago, this list was dominated by traditional mutual funds. So it's just something to note. But we want to spend some time talking about this one, comparing it to the performance of its traditional counterpart, which has been around for quite some time, and then just draw some conclusions. But from top to bottom, I do like to hunt for opportunities amongst these, starting right up at the top, and it is a source of investing ideas. Here's a look at some of the stuff we did talk about during last Tuesday's bull session. Fidelity Blue Chip Growth in the ETF form has actually been in existence a little bit over a year, so hence you see this June 30th. So a little bit different, but the fund that it's actually mirroring, if you want to think of it that way, has been around for quite some time. The 10-year performance is shown here, but the mutual fund is FBGRX, that's Fidelity Blue Chip Growth. And when you look at that over the last 10 years, you see an annualized rate of return of about 23%. So really strong performance. And what we're doing here is just kind of comparing them side by side to see how they compare. And you can see that they are fairly comparable. The main difference, and we talked about this a lot on Tuesday, is that when it comes to an exchange traded fund, I do think they're safe to invest in. We're going to continue to explore this topic, but you're looking at 0.2% less expense ratio, so 20 basis points less in expenses, and that's money basically straight in your pocket. Over the decades, that can be quite significant. So that's the main thing. And then this one has been kind of red hot, and this one shocked us a little bit as we were digging in a little bit deeper. On the left-hand side down here, you can see the actual holdings that are in the ETF. And keep in mind that these are updated every day. So this is a very current list. On the right-hand side, this is the sister mutual fund. You can see that the M is there, and you'll see that they do compare pretty favorably. Even the percent of assets is pretty much the same, with some minor exceptions from side to side. But keep in mind that these update quarterly. So you're looking at holdings in the traditional mutual fund that are a couple months old. There aren't any real major differences. I see that Lulu is here. It's no longer in the top 25 holdings of the ETF, but that's the one major difference that I was able to spot. You can see that Nike has drifted down here a little bit. So it'll be interesting to see how these align when the mutual fund next updates its holdings and see how it compares. But the thing that we really noticed with this particular fund is, these quality ratings of 70, 80, 90-ish all make a lot of sense for a company or for a fund that has blue chip growth. The words blue chip in the title. And then we notice that these other companies are kind of creeping in there. Lyft and Uber. SE, which is a gaming company, very highly regarded by Kathy Wood and ARK Investments. This is Carvana. Here's the Snapchat people, and Caesar is a gambling gaming situation. All of these are fairly highly regarded situations by Kathy Wood and ARK Investing, and it's just kind of interesting to see a blue chip growth fund with these kind of sneaking in there, and it's obviously been working out pretty well based on those annualized total returns for Fidelity blue chip growth over the last approximate year. So these have been fairly interesting areas to be invested in. So again, side by side, the ETF is going to compare pretty favorably to the sister fund, which has been around a little bit longer. You can see that the growth rates are similar. The quality is pretty much similar. Notice that the T. Rowe Price version of blue chip growth also has a slight 11 basis point advantage when it comes to expense ratio to this situation. So just again, the reminder that with the ETF, you know what you're owning because it gets updated every day. And just notice that Lilly's actually the number 25 on this list. Kind of interesting that they're there. Okay. So let's talk Groundhog a little bit. Oh, looks like my... A little bit of disruption on a feed over here. Let's talk Groundhog. We're halfway there. Go ahead and hum the song as we go forward, the Bon Jovi song. We did cover this on Tuesday. It's just included here for those who may have missed bull session this week. It's a bit of a celebration of the 6-month point, the halfway point in the contest. And you can see, as we made the point on Tuesday, Terry Grissinger, who actually passed away this year. So we're looking at a potential posthumous winner here. And by the way, over the last several days, her investments in gene splicing or the gene editing companies have driven her up to like 55%. So she's doing a bit of a secretariat impersonation in this race. But again, hailing from Pittsburgh, that suburb of Punxsutawney, pretty good performance so far. A few users have pointed out the number of ladies who are among the top 10, the top 20. I would say that's consistent with the investment club heritage. A lot of very familiar names. We might have to refer to this as Nick and his harem. Nick is out of New York, and he's been doing quite well here of late. We also noticed the ones in bold; those are investment clubs, and a lot of solid investment clubs, including many local model clubs. Their entries showing up at the top of this list. Again, the average participant that checks in at about 6%. We usually see that number slightly higher relative to the market. We generally see a few more participants beating the market, much higher than that 29.9%. And interesting that there was a little bit more fence swinging this year, but a lot of very familiar names. Look forward to seeing you guys soon. And again, it's not being critical, it's not being disrespectful, it's just a humility reminder, because Kathy Wood has been red hot for so long, and her basically her ARC Innovation ETF, if it were ranked versus the participating groundhogs, would rank 134th of 144. Like I said, they've been a bit chilly over the last several months, but I wouldn't bet against them long term. And so that's just there for a little bit of perspective. All right, just some kind of closing thoughts again as I'm penning some thoughts about lessons to be taken away from the last year or so. This is something you'll probably hear us talk about on Tuesday during bull sessions, but this notion of chasm cartography, Ken and I actually presented this presentation of just basically a month into the worst moments of the stock market as the economy kind of went into lockdown and fell apart. Analysts went crazy, and we tried to do our best to ignore when appropriate. The analysts were way off the mark about a number of things over the last year, so we have to figure out ways of keeping that in check. That's kind of what this presentation was about, and it was a reminder about the type of long-term perspective that comes to our stock study techniques, our analysis techniques and portfolio management disciplines when we deploy this very powerful discipline of not letting temporary disruptions get in the way. So you think in terms of, well, what might the other side look like, and how far out might it be? I don't think any of us dreamt that we would see an economic recovery that basically took 6, 9, or 12 months, depending on what industry you're looking at. Some companies were actually immune from it. But again, our tools, the business model analysis that we go through, really shelters us from possibly making some mistakes. And I'm going to go back and take a look at this presentation. You're invited to do the same. And I'm kind of collecting my thoughts up into the notion of the chasm, the spasms that were experienced by both the rhinos and in some cases us, because I allowed it to distract me a little bit. And the distractions can really be a nuisance for long-term investors. And then this notion of reconciliation, because when the rhinos are going through their spasms and they're getting frothy or extremely pessimistic about companies, it just wrecks the PE ratios. It wrecks some of the profitability characteristics and trends that are in place, and a real recency bias thing sits in, and it can get terribly confusing, and you really have to be able to take a deep breath and recognize that the other side of that chasm just might be a pretty good situation. And again, kind of dialing back to the Boston beer thing, is in my mind, my instinct is that there's a pretty good probability that that's quite an overreaction to the damage done to a significant but relatively small slice of their overall business. And when you think back to what the economy has gone through, so again, the spasms, and then this notion of reconciliation. We saw it with Boston Beer, saw it in some updates here this morning with NVIDIA, where the analysts just kind of got out of control with respect to PE ratios. So those type of disciplines are important. So that's what I'm going to try and collect up some thoughts. Please forward me anything that you'd like to cover on that. So with that, just our reminder that you can find presentations like this, including the successful investing conferences that were referenced a few times here today. The one with all the selections, in this case, was the stock panel from May 2021. If you go to YouTube, hunt for Manifest Investing. We also archive all of the bull sessions and roundtables there. So those are there for you to check into. And what I have really enjoyed doing here over the last few weeks is if you go to the page and you actually do a search on either a ticker or a topic, you can find them. And YouTube does a real nice job of queuing them up and giving you a quick look. I actually had a number of inquiries from people talking about the projected return on value, and they went to YouTube, did a search on projected return on value or prove or whatever, ended up in places like this where Ken and I covered projected return on value last November, and then there's been some other bull sessions where we covered it. So they were taken directly to that. So with that, can I open up the floor for any questions that anybody might have? I'm going to go ahead and shut down the recording and stick around and just kind of open up the floor. So thanks everybody for chiming in. Let me know what's on your mind if you have any suggestions or answers to some of the questions I've posed. But for now, we'll go ahead and say have a great weekend, and let us know if you find anything really interesting in the realm of investing. Thanks, everybody.